Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. So over the past week, gold prices have shown some signs of picking up. Right now, the market is mainly driven by the bulls, but to be honest, the trend is still a bit up in the air. A few economic stats taking a bit of a chill pill in the US and some geopolitical tensions cranking up can explain some of the upward moves. However, the potential game changers this week are the FOMC meeting, Powell's speech, and the U.S. non-farm payrolls report. Those results could shake up how investors are holding on to their gold bets, and that could shape where gold is headed next. So look at the daily chart for gold against U.S. dollar, and after the price has hit the October ceiling at 2009 last Thursday, it seems like the buyers are making a comeback. Gold prices this week managed to break through the 5-day EMA and 20-day moving average, even touching a crucial resistance level at $20.48 yesterday, a place it last visited back in April last year. Right now, gold's hanging around $20.40, also very close to the 38.2% Fibonacci retracement level from January's downward trend. On the bright side, we're keeping an eye on yesterday's high at $20.48. If it is breached, then the mid-January peak at $20.60, also the 61.8% retracement level, could be the next battle zone. If prices take a breather, then there's a chance of the 2000 to 2009 US dollar neighborhood might attract some buyers. Now, why is gold doing this little dance? Firstly, some US economic stats are taking it easy. December's core PCE growth year-on-year came in at 2.9%. Well, not the party people were expecting, and hitting a new low not seen since March 2021. And in December as well, durable goods orders didn't get a bump, taking a noticeable dip from the previous 5.4%. Basically, it looks like inflation is doing a bike slide towards the Fed's around 2% goal. Plus, with the preliminary estimate showing a 3.3% quarter-on-quarter GDP jump in quarter 4 in the US, way higher than anyone expected, along with the improvement of the job openings and the US consumer confidence index, the thing is looking pretty good for a soft landing scenario. And if the Fed doesn't act well, inflation chills, the high real rates can potentially put a squeeze on the economic activities. Well, we also need to keep in mind that the US budget deficit climbed over 50% last year, and public debt growth sprinted ahead of GDP growth by 154% during the same period. As the data cools and the pressures from the debt pile rises, it kind of challenges the value of the US dollar. Add to the stellar performance of the US stock market since October, and folks don't really feel as much need to stash dollar under the mattress for a rainy day. And since mid of January, the software pricing for Fed rate cuts has been climbing, with gold looking more attractive with lower opportunity cost and the dollar losing some of its charm. People are leaning towards more on gold, giving a little boost to the asset prices. Secondly, the geopolitical drama is still a big player. The Red Sea situation keeps getting more intense, and for the first time since the Israel-Palestine clash, U.S. military casualties in the Middle East are making gold shine as the go-to safe bet. Well, even though gold is taking a little step up, there's still stuff to worry about. Despite some cool down in certain U.S. data, the market isn't totally buying into the idea of rate cuts. That's because personal spending is still rocking, and the recent jump in oil prices has some wondering if inflation might make a comeback. So summing it up, gold's taking a little detour upwards, but it's not exactly painting a clear picture of where it's headed. It's more of a hedging, or I would say a standing strong against the falls. The mixed signals from the US economic data and the geopolitical developments are the big players in the current scene. This week, all eyes are on what Federal Reserve Chair decides and what Powell spills, plus the US job reports. With the expectations of solid growth and consumer spending, the Fed statement will probably keep things neutral, and they might even ditch their tough stance. Attention will also be on any comments about the timeline for tapering the pace of quantitative tightening, while any remarks on the interest rates could also significantly impact the gold prices. The non-farm payrolls could also bring a fresh trend to gold, with an estimate of 180K new jobs and a bit of increase in the unemployment rate rate to 3.8%. If the job data surprises everyone by shooting up, it could boost the US dollar, thereby suppressing gold prices. So that's pretty much for this week. Stay tuned with Pepperstone for more updates and insights. And until then, happy trading!